Hi, my name is Toxie. I'm the president of Evergreen Anchor Capital. Continuing our series on my Not So Crazy Mortgage, a series of videos aimed at helping you get prepared for that next great mortgage. Today we'll be talking about tax returns and how they affect getting a loan. So why does the bank even care about your tax returns? Well, we'll explain why in the next few minutes here. But before I get started, I'd like to put out a disclaimer that I am not a CPA, I'm not an accountant, I'm not a tax preparer. So the information that I'm about to share with you is simply based off of what we look at as mortgage bankers when we're trying to get you approved for a loan. So please don't take anything as professional advice. Seek your CPA, seek your accountant before you take steps on anything that we talk about here today. Quite simply, amongst other things, tax returns help the bank verify exactly how much income you make. That way, we can correctly ascertain how much indeed you qualify for. Also, it helps prevent fraud. Now, in a previous video, we talked about the two different types of income. We broke it generally into two categories. One would be W-2 income. That's a salaried income. That is where you receive regular paychecks with withholdings, where your employer withholds taxes for you and on your behalf until the end of the year when you are provided with a W-2. The other type of income would be self-employed income, and we broke that, and generally speaking, the way I had defined it in that video is any type of income where you are in full control as to when you work, how you work, if you work, and all that kind of stuff. Typically, that type of income doesn't have pay stubs and things like that, so it's a broad range, of course, and I explain it that way because it's not simply you just owning a business. It's just any kind of income that comes in different formats. So those are the two. We broke that out into W-2 income and self-employed income, and the way the bank looks at tax returns when it comes to getting a loan, if you work in either of these, is slightly different. So let's go ahead and break down how we look at those two different ways. So W-2 income. If you are a salaried employee and receive a W-2 at the end of the year, it's quite simple. Basically, we don't even ask for tax returns in your case. Most banks don't. Some do. We do not, and most of the banks that we know and partner with do not either. Basically, what happens is if we're just using your base income, some overtime, and maybe some bonus that you make, basically, once we get your W-2s, we just request transcripts on our end. And a transcript is a document from the IRS that's a summary of what was sent to them, because your employer would have sent a copy of your W-2 to the IRS. When you would provide that to us. When we submit a 4506T, that's what the form is called. It's just a request for the IRS to send us a summary of what was submitted to them. We look at that transcript, it matches what you submitted to us, and it's done. So that's the easiest form. Like I said again, if you are a W-2 employee, typically we would not request or need to see any tax returns from you. Please note, however, that if you do make commissions, if you have commissions on there, it is possible at that point that you would need to provide those tax returns, because again, commissions are similar to being self-employed because they're not consistent. Commissions come in different amounts at different times, and so if you do receive commissions on top of your W-2 income, and we're going to use it, right? If we're not using the commission portion of it, if your base covers the mortgage, then we don't need to worry about that. But if you want to use your commission, then we would, in most cases, require your tax returns. So your mortgage banker will be able to help you ascertain if you do, at that point in time. But basically, with a W-2, you don't need to submit tax returns. Now, if you're self-employed, however, it's a slightly different case. In your case, there are no pay stubs to ascertain what you make on a regular basis. Usually, even if there are pay stubs, they're not consistent. They don't come continuously. They're not the same amount of monies on each paycheck. Sometimes there are withholdings or not, but most times you get paid by a 1099 or something like that, where there's no withholding at all. Now, if you are self-employed, the only way we can actually verify your income is through your tax returns. And so because it's not consistent from month to month, we look at the entire year, and that is what is shown on your tax returns. So the tax returns are really important for self-employed, for you if you are self-employed. So we look at the tax returns. You may have filed a Schedule C, you may have filed, K1s, your CPA will help you with all that, but whatever form or fashion in which you file these returns, we look at that, we look at how much money came in, and we look at how much money came out and what you're left in. So we look at your gross, less your expenses, and then at the end of the day, whatever is left is your net income. Your net income is what is used. Now, there are a few things that we can add back in there. We can add depreciation and all that, but we will help you with that. But basically, a very simple way for you to look at it is we look at your gross income less your expenses, your net income that's left, your adjusted gross income. That's what we use to qualify you. And if you're self-employed, we look at the last 2 years, because again, if you remember from a previous video, we have to ascertain that you can make your mortgage payment for the next 2 years, and the only way we can do that is looking at the previous 2 years. So especially this is especially true in the case of when you are self-employed. We look at your last 2 years tax returns, and we average that out to predict, so to speak, what you'll be doing in the next 2 years. We look at that in several different ways too, because hopefully your income is going up. If your income is trending up, we believe that trend will continue, and it will continue to go up this year and the next year and so on and so forth. And that way we still average out the 2 years and use that income. If, however, it's coming down, that's the trend is coming down. If you made less last year, that's your adjusted gross income is less last year than it was the year before. The assumption is that you're trending downwards. I know there are different reasons for that. Sometimes it can be explained, if your work is seasonal or if there was an incident that caused that. But we don't average out the 2 years when it comes to that. We use the lower amount because the bank is being, as conservative as possible to make sure that they're not getting you overextended. So we use the lower amount, and that is what we use to qualify your income. There is, of course, a program that is existing right now, and I have to put that caveat that it's right now because these laws change all the time. But with Freddie Mac, sometimes if you've had a business or you've been self-employed for more than 5 years, sometimes you are allowed to use just 1 year's tax return. It's not the same for everybody, but in most cases that rings true. Especially if you've got a registered business, we can track how long you've had it. 5 years. You'll be allowed to show just 1 year's tax returns. But in general, 2 years tax returns are what we're looking for. So how does that affect you when you're looking at your taxes? Well, what we're looking at is we look at this just previous past year and the year before that, and we want to see that your adjusted gross income is trending upwards. Please note, if you have a partnership, if you don't own your business 100%, there's you can only take the portion of profits that you are equally a percentage owner of the company for. So that is, if you own 60% of the company, you can only apportion 60% of the profits to yourself as income. So here are my 3 recommendations regarding your taxes. The first one, file them. I know that sounds like a no-brainer, but you'll be amazed at the number of people that call our office and haven't filed their taxes. And it is true, there are some mortgage programs that do not require you at all to have filed your taxes because they're not asked for. But the whole essence of these series of programs, of the videos that we're shooting here, is to help you get the best mortgage out there with the best interest rates. Those type of loans, right now they're called non-QM loans, come with much higher interest rates, much higher down payments, and we don't want you getting into any of those unless, of course, we know there are some people who actually have no choice. But hopefully you can do all the things that we're talking about here so to get yourself in a much better position and not have to follow that. So that's the first thing. File your taxes. The next thing, check all the expenses that are put on there. Like I said at the beginning, you definitely want to consult with your CPA, but make sure you know what's going on there. We've had some folks who send us their tax returns and look on there, and there are all these expenses that they themselves cannot explain. And the expenses kind of wipe out all the income that we could have used for helping them purchase a mortgage and purchase a home. And when we ask them, they're like, they're not sure what their CPA did here or there. So, well, make sure you know exactly what's going on there to make sure the CPA accurately reports what you tell them, so that you don't face a scenario where you come to get a mortgage and even though you made a lot of money in your business, everything has been written off to the point that you don't qualify for a mortgage. So that's the second thing, is make sure you know exactly what goes on there, and don't just leave it to your CPA. I know taxes can be, that's the whole reason we pay for a CPA, right, to help us with this, but make sure you understand what's on there, especially when it comes to the expenses that are being written off. The third thing is make sure you get an electronic copy. It makes it real easy for yourself. First, you want that in order to, have a record of your taxes at all times. Keep it in a safe place, of course, but you definitely want an electronic copy so that you can send it to your mortgage bank or to other institutions for other things that you might be doing. Most tax preparers can, upon request, send that to you. I know sometimes you do have to request it, so make sure that you do that and have a copy of that. Properly filed taxes will help ensure a smoother loan process. Again, hopefully to help you get the best mortgage products available to you at the best interest rates and ensure that you have an extremely smooth mortgage process.